Good afternoon, welcome to this week's video. Thanks for joining us, Bill.
We're almost glad to be back. Glad to have you back now that you're not working a night shift.
Let's start with GDP. So UK GDP came out earlier in the week and it was robust as ever. Everything looking pretty rosy over here. But in the US yesterday we found out that there was no growth in the first quarter. How much of that figure can we put down to the bad weather?
Well, first of all, let's back up. Years ago when I was a presenter at Bloomberg, okay, and we got a GDP number, well, I had to come back having a trading background, okay? You know, I have to look at it in the first 15 seconds, good, bad, or indifferent. Now, the point being is that the head of our department there was a former chief economist, and she sort of grabbed me, took her in her office, and well, you can't discuss it. I said, let me discuss this. I said, I'm a trader. I got 15 seconds. GDP is something you evaluate once, twice, and 3 times. What we saw with the UK is something that we have felt and seen for the last year. We even have Dr. Carney now saying, well, now he's sort of sounding like the Chancellor. It's sort of a broad growth process. I think one of the things that we saw, not only with yesterday's GDP number, but today's PMI number, which is even more important to me, manufacturing now, which I was concerned about, was sterling at 165, 166, and of course now heading to who knows where. Manufacturing now is starting to participate in the growth. So that coupled with, you know, we had housing starts were up 10.9%, highest since 2007. So officially, my official call for the first interest rate hike is February of next year. But I will tell you that I'm putting in about a 35% probability now, after yesterday's data, this morning's data, that the ECB could, the Bank of England could give us some people may call it a early Christmas present. Some people might say, oh my gosh, what do I do about my mortgage? So yes, we're seeing a continuation. I agree, with the IMF or the World Bank or whatever you want to talk about, that the UK could be of the G7, G8, or how many numbers we got now, the most positive. In my call is probably something like 3 to 3.1% now for 2014.
Okay, well that's great news over here. But in the States, number wasn't so good.
No.
Was that entirely weather related, or is there something more there?
Yeah, I have to think so, okay? For the simple fact is, if it's 40 below zero, one, you're not going to go ahead and be buying those Jimmy Choo shoes. Our good friend Rosalind will wait to buy her bikini, and how could you buy a house when they can't build them? When it's 40 below zero. So that was expected. And I think the interesting thing is...
But it wasn't expected. I mean,
it was worse than expected.
Okay. Yeah, they expected it at 1.2% annualised, and it came in at basically zero.
Yes.
And some people are saying maybe there's a few things we should be looking at other than just the weather. Maybe the weather's not the only reason.
Well, I think one of the things that you've got to look at is that we know that the housing market is starting to slow down. What's the major reason? Mortgage rates have gone up by 0.5%, okay? And another thing, we talk about pending home sales, okay? Now, let's compare that today versus, if we were having the same kind of recovery 5 years ago, when you could buy a house in Florida for your overdraft on a NatWest credit card, okay? I mean, things were going for like $10,000. So what you're starting to see is pending home sales are getting better. They're not getting great. Why? Because people still have a large amount of negative equity, especially in places like Phoenix, Las Vegas. When you saw between 2005, 6, and 7, I mean, they were going up like 100% a year. So what you're starting to see is, what you have to look there is the balance. You're starting to see an improving pending home sales in the South. We'll start seeing, once the weather does get better, and of course now we have, we'll start seeing more construction, both in the Northeast now, which is normal, and probably maybe even in the Southeast, Southwest, especially in the Southwest, which gets, it's very difficult rebuilding houses when it's 40 degrees in Phoenix or Dallas. So I think we'll see that continuation. And I think, as we saw last night, we had 2 minor changes in the FOMC statement. The first one was, we are seeing, since the March meeting, an improving economic situation. Not great, but an improving. And the second one was, for the first time, we had a unanimous decision. Now, I can't even pronounce Kolkowski or whatever her name is, who had been a dissenter. She voted with the majority, so it was 100%. Okay.
Well, maybe she just got bored of not getting her way.
Good again. Maybe she was upset because she wasn't chosen as the chairperson. So I think one thing that we'll have to look at is we'll have to have this discussion at least 3 months from now to see if we had a better than expected rebound in the second quarter, and if we did, then in the third quarter. So my feeling is, I think we'll have to look at this from an annual standpoint. Now, conversely, the bond market looks at is going to be slower, slower, slower. The Treasury 10-year is still 266. Yes, we have a sort of a technical bounce in the stock indices, but if you saw when the Fed statement was made, okay, you had all of the stock indices in the States hit negative territory. I think what we had was end of month, probably potentially buying there. So I see the market coming back. The question is going to be is how quickly it comes back, and I think this is one of the things, and I think, excuse me, this is one of the things that the Fed basically inferred last week. It will be data dependent and slower rather than anything else. But I think the interesting thing is, have we with the Federal Reserve, because they only have 8 meetings a year, but are we now looking at the simple fact is 4 of those meetings don't have a press conference. So now are we looking at, hey, maybe we only have 4 Federal Reserve meetings. And normally, talking like an old timer, they used to be called a blackout period. 4 to 5 days before the meeting, you ask any Federal Reserve governor, no comment. 4 or 5 days after the meeting, again, no comment. Janet Yellen will make 4 speeches, one of which is today, between now and when the Federal Reserve minutes are pronounced. So that's quite interesting. And I think one of the things you have to look at is she used to write the statement. And so the simple fact is it'll be quite interesting to see. I don't think she's going to slip up again. I think she'll probably say, well, interest rates will be data dependent. Market's still inferring if you look at interest rate futures.
Probably be the same old stuff we already know.
Yes, it's going to be middle of next year.
Let's go back to, you mentioned the UK manufacturing data this
Yes.
morning, which was very strong, and sterling is now at a level which it hasn't been to since 2009.
Yes.
And everyone's saying that it's going to hurt exports. Is that actually coming? Is that coming to be proving true?
Right now, it's one of these things. It's like if it's Mardi Gras on New Year's Eve, right? At midnight, you don't say, oh, God, 4 o'clock in the morning, I'm going to have a hangover. You just have, I'll have another one, I'll have another one. So, yes, I think it's going to be. Now,
So
one of the
today,
things, yes, it's quite interesting. And as I say, I was doing a client seminar last week in Prague. And one of the people who is a technician, and we were discussing the possibility of how far sterling can go. Well, I said, well, I don't know how much higher, because if you look at the CFTC data, you look at client interest, most everybody is already long. You said maybe the Queen, maybe Harry needs to buy something out. He's just broken up with his girlfriend. So it's a question of how much longer can people get? We did 169 today, right now, 170, 175, 172, back to, when we had, and the last time I went to the U.S. in 2008 was brilliant, okay? I was getting more than $2 to the pound. But as you said, are we just going to, well, we continue to be excited about building houses, so therefore we won't care about the export market because people will be buying televisions, they'll be buying new cars, they'll be buying carpets and draperies and everything like that, and everything to go along with the housing market. But one of the things where, and again, I'm more concerned about the 11.2 million people in this country that get a monthly letter from their local mortgage banker saying, don't forget, Charlie, you owe me X, Y, Z, okay? So even a 25 basis points move up, or they're talking, if interest rates go as much as most people expect, maybe 1 full percentage point in 2015, that could add anywhere from like 185 to 460 pounds on your interest rate only mortgage. And if you're paying both interest and principal, that is going to be something that could cool the market. So I would be more concerned about that damaging consumer sentiment, consumer spending, rather than the exports right now, because, maybe the only thing that's helping our exports is we're not as bad as the euro, at 138.85.
All very interesting.
And you mentioned yesterday, okay, if you follow the euro, within 5 minutes after we got the US GDP number, all right, the euro went from 138.25 to 137.70. You know, it's not supposed to do that, okay? Within 25, 30 minutes, it was up more than 100 pips. But then that was also a situation where if you looked at the euro from a technical standpoint, it's like, how much higher can it go? Of course now, unfortunately, I will not be here next Thursday, because next Thursday we could be discussing, well, what is Super Mario going to do now, Magic Mario? Because, you know, we go back to October of last year, if you remember that. It got to 133.50. What did the ECB do in November? Oh, rate cut. And so, you know, is it cynicism now that everybody says, oh, ECB, it's as bad as Trichet, you know, they just sort of chit-chat, you know, the meetings are just discussing wine or what's happening with the, you know, the sherry market and this, that, and the other. So that's going to be interesting, because I mean, the last time I looked, it was still like 138.77. So what I've seen from a technical standpoint, there were a number of people that had bought it all the way up to like 135, all the way up to like close to 137.50 to 138. Then if you look at it from a technical situation, also looking at the CFTC data, the market was really overbought. Well, if it was overbought at 137.50, what is it now at like 138.75? So it's now going to be a situation where, you know, you've got some major accounts out there, okay, in the last, you know, month or so, whether it be on Bloomberg or Reuters or the FT, talking about, you know, a very low number for the euro, not 125, 120, but in the very low 130. So that's going to be a situation where, you know, have they covered longs or shorts, etc. But you know, it's a situation where I think sterling could go to 170. Do I see it at 174? I mean, who knows? I mean, I'm not even looking at those numbers. I think that would be too high, just to the point that you were talking about. Excuse me, what will it do to the export market? And my God, you know, having been to Slovakia, having been, you know, to the Czech Republic, you know, having a number of clients that are in Romania and Bulgaria, these countries all have massive deflation, okay? And so, you know, they can't export anything at 135, 136. So at 138, 139, and 140 for the euro, well, this is a very serious problem. So, you know, the ECB has to look at it as a entire picture, rather than just information coming from Berlin only.
Yeah. Okay. Let's quickly finish on non-farms tomorrow.
Yes.
Expected 215,000 new jobs or so. How did the market react if it did come in like that? We've been used to slightly lower numbers.
Well, my call is 250 and has been for about 3 weeks, okay? I'm looking at 250 and 6.6%. The question is that if you look at the interest rate futures, it's a question. They're almost discounting the 250 to 300 level. If you're looking at Fed fund futures, okay? They've hardly moved at all. So that'll be quite interesting. Now,
so the trade is sell the dollar, buy the dollar, sell cable.
Well,
and buy the Dow or the S&P.
Yes, and I mean, in reference to the foreign exchange, that's what happened within, you know, as I say, 5 minutes after yesterday's U.S. GDP number was saying, you know, I guess the people that decided to be bullish on the dollar, just as I said, this is a one-off. This is totally weather-related, you know. It's one of these things where, you know, you ever played like one of these rubber balls where you drop it like this and it bounces up 500 feet? The people in the first 5 minutes after yesterday's GDP number, if you saw how the dollar reacted, especially against the euro, boom, that's what everybody was doing. Saying, man, we're ready for some major rebound. The Fed will tell us exactly what they told us last night, and I'm looking at 250,000 and a positive non-farm payroll number for tomorrow. And that was the trade for 5 minutes, okay? 10 minutes later, it wasn't the trade. So it'll be quite interesting to see how the U.S. equity markets closed today. You know, we've got a new month and everything like that. But also, again, the positioning is basically how many people can still continue to go long. Maybe the Queen's the only person that's still available to sell sterling, and how many people have. It may be time to close out their long euro dollar position.
Well, let's see. All right. Well, thanks very much for everything today. I'll see you not next week, but sometime in the future.
Lovely.
Thanks.